Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
I'm here.
Ryan,
You're
back.
I was banished, and I'm back. The prodigal son has returned.
Yes, the people are finally going to get what they want.
Mm-hmm. I know.
It's no longer just me.
It's very exciting. I mean, I don't know.
Is.
It's been like a month. You didn't want me for a month.
Well,
we broke up.
Is,
now we're back together.
Yeah. It's kind of like
again. That's good.
It's kind of like Ross and Rachel, right? This kind of off and on thing.
Mm-hmm.
So, but now the thing I will say though is, sadly, the quality did suffer without you. So I'm glad you're back on. So,
well, it's exciting to be here again. We're going to just spend our time today talking about why the market is just so crazy.
Right.
Now, as we speak, World War III may be starting. So
I know.
It's a big part of that to know. But we're going to talk about why maybe don't worry too much.
Right.
Maybe.
No, exactly. And that's, I mean, and just for everybody, listening, we've definitely have, more regular episodes coming down the pipeline. We've got a couple things recorded and a couple ideas that we want to, bring out. So, but the main thing that we want to understand right now, and the reason we wanted to do it this way today is because, there's so much craziness going on, right? I mean, we're seeing volatility unlike we've seen for quite a while. So, I think it's a good thing we're diving into this right now.
Yeah. So
especially with World War III on the doorstep. So
yeah, right. And a new version of Hitler's out there.
It's kind of crazy. Vladimir Putin riding bears and topless, shirtless pictures on bearskin rugs. Like the guy's crazy.
So yeah, bonkers. I shouldn't be laughing, but anyway.
But it is crazy.
You're going to walk us through a couple of ideas. And I'm going to ask you the questions. Mm-hmm. And then you're going to talk for 15 minutes straight. And then I'm going to come in with another question.
See, this is why you haven't been on the podcast for a while. Is you're like, I'm so damn sick of your ramblings.
Yeah. I'll stop you.
Okay.
We're going to try to make this quick and easy.
We need to have let's get you a bell for your office. And if I'm ever rambling too much, just ring the bell.
Yeah. It's too bad we can't be there because then I can have some contraption that smacks you in the face.
That smacks me in the back of the head. I like that in studio.
Yeah.
Hey, one thing I do want to remind everybody of really fast. Just because as you and I have talked about, so we are changing the format, like the kind of the consistency, the timing of our podcast. We've changed it up a little bit. And, mostly because we want to make sure that the quality's there. We want to make sure that we're putting these things together the right way for our listeners. But also, Ryan and I, obviously with the craziness in the markets, we also have our day job, right? We both run an advisory firm. So, that takes a lot of our time. So we want to make sure that, we're giving the right amount of time and focus on, all the different pieces. So just a quick reminder that what we'll do is we'll drop a full episode 1 week. And then the next week I'll just do the little market mini, and then the next week a full episode. So we're gonna shoot for that kind of consistency and that flow, so that there's more in depth information if you want to dive a little deeper every other week. And then the other week, obviously, it'll be just the market mini, a couple quick minute recap. So, so that's what's going on with Ty and Rye. All three of you, that's what's happening with the podcast.
Adjust your calendars.
Adjust your calendars.
Yeah. Oh, a buddy of mine started listening. So Brad, adjust your calendar, buddy.
Nice. Glad to have you, Brad. Sorry.
All right.
In advance, Brad.
Let's talk about year-to-date numbers. They're really great.
Yeah, it's been a great year so far. So, yeah. Actually, so and that's what I want to
If we're
jump
playing
into.
golf, this has been a great year.
Oh, it's been phenomenal. The crazy thing though that I really want people to understand when we think about year-to-date numbers is everybody thinks the entire market is just falling apart, and it's not. That's not true at all.
Yeah.
Right? There's pieces of the market, different subsectors of the market that are still doing well. And what's interesting about that too is the idea here is the market for so long, S&P 500, right? What have been the bigger players in the S&P 500? Technology.
I thought you were asking.
Right? Oh yeah. Well, I kind of was, but it's okay. Technology, right? Like
yes,
technology. How much S&P was very heavily weighted with what they call it FANG, right? Facebook, Amazon, Google, all that fun stuff, Netflix.
Yep.
And so that's one of the parts of the market. In fact, so year to date, this is through end of day yesterday. So today's the 24th. So through end of day the 23rd. So we're seeing technology down almost 16%. Right?
Crazy.
So it's not fun. 16% is never fun. That's definitely in kind of correction territory.
Especially any of you, which a lot of clients, they're like, get me Google, get me Tesla, get me Apple.
Yes.
I mean, it had its data last year in some.
Yeah.
Sheesh.
Well, even more so too, the meme stocks, right?
Mm-hmm.
And we're going to talk about that here a little bit later in this episode, but cryptos.
Yeah.
Right. That basically what it comes down to is the higher the speculation that you held, the bigger you're getting your butt kicked. The more you're getting your butt kicked right now.
Those
right?
swings are much bigger. Yeah.
Yeah. No bueno. Right.
What's that?
But no good.
Gotcha.
For those that don't speak Spanish.
Perfect.
I'm trying to think of it in German. I don't know why the Spanish is coming into my mind.
You know German too.
I know, and I speak German.
It's no guten Morgen.
No, es guten Morgen. So, but so the interesting about that is that's where people are kind of feeling the pinch, right? Well, okay, if you look at, there's a couple of parts of the market that are doing well, are actually still positive. So energy is up 22% on the year.
Yeah.
Just in the last, I mean, how many weeks are we now? 6 weeks, 7 weeks, right?
Yeah.
22% in 7 weeks. Last year, it was the leader in the clubhouse last year too. The financial sectors, right? Still, I mean, the financial sectors, they're taking a little bit of a beating this last week, but overall on the year, right, it's only down about 1.5%. Consumer staples,
that's got to be
right. Good. So like the Walmarts of the world, those kinds of things, right? So the point is that, and we'll dive into some of the reasons why and things like that, but there's got to be this understanding that just because certain parts of the market are taking a bigger beating doesn't mean that there's everything is lost and let's head for the hills, and right, we're definitely seeing more panic right now, and so that's obviously why we wanted to have this episode is have this discussion.
Yep. And so what's the Warren Buffett analogy or quote?
Fear and greed, right?
What is it? Give it to me.
When people are greedy, it's when you should be fearful.
Yeah. Uh-huh.
Right.
That's the other side of it.
When people are fearful, it's when you should be greedy.
Yeah.
I'm going to butcher this stat, but
perfect.
That's what I like
butcher
to do.
That thing.
I like to
talk out of context. Let's not
totally
fact
out of
check.
context, right?
Here we go.
No fact checking. Okay.
Ty's butchering.
So,
Ty is the butcher. That's your nickname from now on.
I'm trying to remember the analyst's name. Sorry, I don't have it off the top of my head.
There's
a measurement. There's a measurement of like you can kind of start to see trading data. You can see like kind of how where banks are kind of stockpiling money for their in their investments and things like that, and where they're going to invest. and you kind of see this whole positioning of being poised to buy, right? You can see institutional traders doing that.
Yeah.
And it's kind of uncanny as you track. And again, I'll put it in the notes of this episode, right? In the podcast link notes, the actual article from the analyst and the actual a link to the graph too. And it shows as you start to see those institutional investors stockpiling up their cash, it's kind of in that same sentiment as Warren Buffett, where it's like, okay, we're going to start getting greedy here. Why? Because everybody's panic selling. And it's not an exact science, right? Because it's all the whole point of everything you and I discuss is we want to gather information and extrapolate, in an educated way. What can we, what does this mean? Well, as you watch that stockpiling and then they kind of execute and start buying, you start to see those. It's usually right at that as we're starting to kind of come into those recovery periods, right? And sure enough, we're kind of in that same range right now with institutional investors poised to buy back. We're at the same levels as they were in March of 2020 at the end of the COVID sell-off. Like literally, it was March 18th, 19th when that was at its highest point. And that's exactly where it's at right now. So my point with this is to say, okay, does that mean I should go buy everything, buy it at a discount right now? No, right? We're not making a recommendation one way or the other. But very smart people that work at very successful, very lucrative firms are positioning themselves to follow exactly that advice of Warren Buffett.
Mm-hmm.
Right?
Yeah, because you got to look at it. I don't know if it's you told me. I think I might have. Timmer might have posted this. 85% of quarterly reports are positive.
Yeah.
I know
exactly. And the other thing too, because I mean, again, don't get me wrong, writing a correction and just so everybody knows, like let's kind of set some boundaries as to what numbers are normal, right? What's kind of like a quick sell-off recoveries in that 5% range. A normal, what we call correction, a healthy correction is kind of in that 10% range, 10 to 12%. And I'm saying like peak to valley, like what are we down, right? And then once we start to really get into that 15 to 20% range, that's where we start to say, okay, is this really turning into a bear market, right? So we're when you go all the way back to November, we saw some sell-off in November, right around Thanksgiving. We're still in that healthy range, in my opinion, but there's definitely plenty of people saying, oh, it's a bear market. It's going to be a bear market. Right.
Yeah. We're butting up against that now.
Yeah, we are. But what I would say is this, obviously can, make changes in your portfolio, right? Yeah, that is good. Right. And we actively manage money. So we do make changes. We've been, adjusting the portfolio over the last 6 weeks, but what the key thing I want to get at here is you and I would be having a very different conversation if there wasn't economic data behind the scenes,
right?
To kind of give us that warm fuzzy that look, there's a lot of evidence to point that there is some corrections some recoveries on the horizon. Exactly, you just brought up a great point, right? Q4 earnings reports were awesome. Projections, for the most part, awesome. And even too, I did a little bit deeper dive into some of those correction pieces, some of the forecast pieces that were lower than average. The majority of those that are projected to be lower than average are all, and I should say all, but primarily tied to supply chain issues, which again, it's something we understand and know.
Yep.
Right. So it makes sense. One other last little key stat. Just yesterday or the day before, the Q4 economic growth data, they increased it another 7%. They revised the data, right? Which happens from time to time, right? The earnings reports, the growth data, the economic data comes out, and then they'll go back and they fine tune it and they adjust it up or down. Obviously, it's bad if it goes down. 7%. The growth in our economy was not just 7%. It was 7% higher than they had originally published a month ago. So the economy's growing, right? The companies are still in business making money. People are still getting paid, right?
Yeah.
So again, can we still have corrections in those kinds of places? Absolutely, right?
Of course.
But I don't know, fear's a little bit blown out of proportion in my opinion. But
Right. So should we adjust the portfolio?
well,
Right now?
we've definitely made changes like
Live
we're
on
talking about.
camera. Should we adjust it right
Live
now?
on camera.
Yeah.
Do you want me to execute the trade right now?
Yep.
I could, but that would be a little foolhardy, if you will. The other thing too, not only foolhardy. Yeah, do you like that one? So not only is energy, yes, we're gonna start busting out the
that sounded more like Sean Connery than
that actually did was a little more like Sean
Yes.
Connery than George Bailey. Go back and listen to our
Christmas
to,
special.
Our Christmas special homage to It's a Wonderful Life. Commodities right now are right. What information did I send you last night about commodities? Right,
crazy,
blowing it out of the water, right? And so now again, it's like, okay, well, why is there a sell off? Right. That's, I mean, people, okay, Ty, yeah, it's easy to sit back and say, hey, it'll be fine tomorrow, but why are we losing? I mean, again, did a lot of the market was at all-time high. A lot of the price to earnings ratios were way out of whack. Inflation, right? Inflation's a big deal right now.
Mm-hmm.
Interest rates on the rise. That's a big deal too. Right. So there's definitely factors that they warrant a correction, right? Corrections happen. That's kind of the only thing that I feel like, over the last, 5 or 6 years, people need to understand is, we've been kind of in this really long sustained bull market, right? Rising market, where as things have kind of, triggered some sell-offs, the Fed has jumped in and done quantitative easing. So it kind of keeps the markets growing faster. Right.
Right.
And so it has been a propped up. It has been a little artificial. So the fact that we're having this, 10, 15% correction, in my opinion, it's like, look, that happens. That's normal. Right.
Yeah.
There's nothing underlying that, in my opinion, is so egregious or ugly that it's like, oh, you know what? Maybe we need to walk away from this thing. Right. There's no, real estate's overvalued. It's going to correct. There's going to be some corrections there, but not to the extent of 2008. Again, are there jobs? Are people still working? Is unemployment coming down? Right. So I think it's this idea that, that we've ridden those highs and we're kind of going through this normal, healthy correction. And one last thing, I'll stop rambling because you probably should have rung the bell like 5 minutes ago, but
should have. I don't have one.
I know. The last thing I'll kind of throw in here, and this is, I don't take this as fact. I don't really have a lot of data to back this up, so I'm going to speculate a little bit.
Here comes the butcher.
What's interesting in today's market more than ever before in the history of trading in our market, in fact, I would say if we polled our audience, if we even had an audience 10 years ago, 5 years ago, how many of them had a Robinhood account? Right?
Mm-hmm.
Versus today, we poll our listeners today. How many have a Robinhood account? That number would be, well, mostly because Robinhood really didn't exist much, that much 10 years ago. But you get my point, right?
There wasn't.
There's more. There's more retail traders than ever, and there are more robo accounts than ever, right? And robo account is just, hey, it's an algorithm. It follows basic rules. If something breaks through a resistance barrier, it's going to automatically sell and protect your portfolio, yada, 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 right? A poor man's money manager, right? We have more of those than ever. And over the last week or so, NASDAQ's broken through that floor, that resistance floor. And basically what a resistance is you kind of have a sense of what's kind of a sense of normalcy as far as trading for any stock, any index, right? And when you break through a floor, it's more problematic than if you break through a ceiling, right? So you've had Dow, you've had NASDAQ, and now even S&P 500 break through that resistance floor. So it kind of, in my opinion, it kind of begs this idea that, well, okay, if we have a lot of, fearful retail investors who are like, crap, panic sale, and you have a lot of robo advisors that are programmed to sell off, what do you think that does to the sell off?
Yeah.
It intensifies it.
Yeah, it intensifies the process because everybody's going to be feeling it. It's sort of the reason why you just see good companies with stable foundation seeing their stock values go down, because that affect everybody now starts to jump on board. We're like, okay, I don't want to write this down to the bottom.
Right. Exactly. That's exactly the point. Is it's a little more emotional, right? And that's what kind of what I was talking about before, when you're starting to see more of these institutional investors really not make an emotional decision. It's more of I guess, greed can be an emotion, right? But it's more of a calculated decision on their part versus
for
the retail side.
Calculated. We're going to stockpile this, and there's going to be a moment where we know, okay, panic is pretty much over. Let's go. And that's the problem with panic selling, is you are likely going to miss a good portion of that upswing when it happens. You're going to miss it.
Right.
Because emotionally, you're not ready to read the signs that says we're ready to go. Right. So, don't panic sell. Is that what you're saying?
Yeah, that's what I'm saying. I mean,
we can't. Don't say that.
Don't panic sell.
Don't panic. I mean, whatever.
Well, we're not telling you what to do one way or the other, but the idea is the idea is okay, like how do we avoid this, and should we even be like, the idea is I mean, adjustments need to be made, right? Even like we talked about, right? Like there's our portfolios for our clients have less tech exposure than they did 2 months ago, 6 months ago, right? Mm-hmm. Do we have more energy exposure? Yeah, we do. Are we glad we do? Absolutely. Yeah. Right? Do we have more defense positions? Yes, we do. Right? So yes, we're making adjustments because in a correction it definitely warrants that. But the idea is, okay, how? And I'll ask you this question first. What are some things? Because I like this. You've written some good articles for our advisory firm newsletter, like more of the psychology side of this. Because I'm trying to think of better ways to help people avoid these panic sells. But what do you think? What are ways that clients, that people listening, how can they really not freak out when the markets are down like they're down right now? What do you think? What would you tell somebody? Well,
there's a couple of problems that I think that people run into. Is one problem is that their investment accounts, whether it's IRA or not, are actually savings accounts.
Yeah.
And so they're trying to make money with their savings accounts, but freak out when the market doesn't do well because that's their savings.
Right.
Right. It's not a long-term investment for them.
Right.
So one of those things would be is that don't use money that you need.
Right.
For investing, because you're just automatically going to do this, and it's not going to be good for you, and you're going to lose money.
Right.
So that's one problem. I've seen that recently. But really the bigger issue is, honestly, if your investment account is a long-term investment account, meaning retirement account, you're not going to see it for 10 years.
Right.
Don't look at it.
Right.
Every day. Don't look at it every week.
Right.
Visit it like your relatives at Thanksgiving.
That's such a great analogy, right?
Just peek in, say hi, and get out.
You mean like at Thanksgiving, like the turkey bowl, where you
do
really
the minimum that you need to do.
You try and tackle each other, and you end up with a sprained ankle or a pulled hammy because you're out of shape.
Because look, if all of you spent every day or every week with your relatives, you'd go crazy.
Right.
You
Absolutely.
need to separate from it. So that's kind of the thing is that don't look at it all the time. Don't look at it all the time. And you got to have some checks and balances too on your emotions, because we've talked about this a lot. we talk about the panic sell, but like if you can then step back from it and say, is my decision based on some rationale that I've studied, looked at, researched, or is it reactionary and I'm just emotionally looking at this and going, and you have that. If you make that noise, and it's like, an extended
are you
sigh.
dying or going to the bathroom?
Exactly. If that's the net noise that comes out of your face, just take a step back. Go take a nap. Go eat some protein and some fatty foods. Get your brain working again and come back to it. Because you are in an emotional state in which you're just going to panic and make completely irrational decisions. So stop looking at your accounts. If they're long-term investments, stop it. Because it's not going to do you any good. The market does these things all the time.
Right.
And particularly if you have a money manager, like talk with your money manager and have them sort of handle this process. You know?
Right. And that's the thing is there's actually a study done now take the study with a grain of salt, the Dalbar study.
Here comes the butcher.
Because the what?
Here comes the butcher.
So the Dalbar study, it was done by advisors.
Oh wait, this is not a butcher story. Never mind.
No,
I retract that.
So the Dalbar study basically went through and it followed, I can't remember how many people's portfolios over a very, I want to say like a 20, 25 year period of time, 30 year period of time. And they've now, because the initial study was so successful, there's been a whole lot of follow up to this. Again, take it with a grain of salt. And I even hesitate sometimes sharing this because I'm an advisor and a money manager, right?
I don't take it with a grain of salt. I think it's real.
What they found was there's a material difference between people that utilize a money manager and people that don't. And we're talking, upwards of 5% plus excessive returns with a manager versus just managing it yourself. And again, it comes back to the psychology, right?
Yeah.
I mean, don't get me wrong. I have an ulcer the size of Oklahoma managing money. Right.
I mean, that's not that big, but still.
How many times do I complain to you about the markets as we're managing the markets every day? Right.
Yep. I count on that 7:30, 7:40 text in the morning.
That's
every
true.
Day. I count on it. I just know
you did get that. Yep.
It's coming.
Yep. You got that text this morning, didn't you? But even with all that, right, we still have we've got our rules, we've got our portfolio standards and philosophies in place. We have a plan in place already.
Mm-hmm.
And that's the idea is that the tendency to being emotional is reduced when you have somebody else that's kind of running it for you. Yeah. And so I love that you're sharing that, and the way you put that out is it's the psychology, and it's taking a step back and kind of relaxing. And you bring up an even better point. If you have everything writing on the daily gains or losses of your portfolio, something's wrong with the big picture.
It is.
Something is way out of whack with the big picture.
Yeah. You've got to make some changes if that's the case, for sure.
Exactly.
Yeah.
Exactly. So take that step back.
Well, and this is kind of going into this other idea of cryptos, because cryptocurrencies have just made this splash in our zeitgeist. Is that zeitgeist? Is that
zeitgeist
the proper term? Fact check that, Butcher. Let's see if that happens. Zeitgeist, I believe. A cultural understanding. Cryptos are now part of this. And look, cryptos are like meth.
Right.
They give the greatest highs.
Yeah.
And then provide you the lowest lows.
And
then send you just on this journey to find that high again. I mean, you look at cryptos this year, even the big ones, Bitcoin and Ethereum, they're down a lot, 20, 30%. And it's fast. It is fast.
Yeah.
Right? I actually, in my own personal account, wait, can I say this?
Yeah. I mean, you're not giving advice. You're talking about things that you trade.
Okay.
Sure.
Asterisk, not advice. I put a buy order on Ethereum at 3,500.
Mm-hmm.
I was thinking that was a resistance level. It's going to go down at that. Got there, hovered there, and then went down to 2,500.
Right.
Right. It'll come back for sure. Over time, those things can work. Now, that's me just sort of experimenting with it. It's
Right.
very little of what I've got.
Right.
But I like to have my hands into it because it's kind of is exciting.
Right.
It kind of is meth. Right.
Exactly.
But this is the thing with the crypto part is that in volume, it's not that much. Compared to the stock market, it is not that much at all. So what does it mean? It means that the big players that are involved can manipulate values way, way easier, way, way more.
Right.
They can sell off and cause the panic, and everybody sells, and it drives that price down. And then they're like, okay, let's pick up some more.
Let's pick it back up. Yeah.
I mean, there's just no way around it. It is the big fellas that are really directing the value here. Because we've talked about cryptos and their value. It's really tough to figure out what their values are. It's tough to figure out what its intrinsic value is.
Yeah, because it's speculation,
based
right?
on?
It's all speculation. Exactly. Yeah.
What did Buffett's partner call it? Did he call it snake oil?
I think
he called it something
Munger,
else.
Yeah, Charlie Munger called it. Yeah, exactly. Yep.
Let's fact check that. The meaning was snake oil.
Yeah.
I don't know if that's the term he used. Now, whatever. Everybody can make their own decisions about it. But just keep in mind, from a crypto standpoint, it is a wild ride.
Right.
I mean, if you had any investment that could drop 50% and then rise 50% several times within 1 year, I don't think outside of the crypto, I don't think anybody would ever want to do that.
Right. But
still, people are doing it. And I tell people all the time, like, it's got to be a small percentage of your portfolio if you're going to jump into that
exactly.
ring. Because this is like getting into the ring with Mike Tyson in Mike Tyson's Punch-Out. Did you ever play that?
I did.
It was impossible to beat Mike Tyson.
Yeah. Right.
You had to spend your time, and I did, by the way, and I beat him.
Did you ever beat Tyson? Nice.
I beat him, but it took me a year. I don't know how long.
Wow.
Soda Popinski, he took some time too.
Right.
You remember that guy?
Yeah, I do remember Soda Popinski. Sandman.
I don't know very many people. Sandman, yeah.
I was happy. I just Glass Joe getting past the first round. I was all happy about
Joe.
that. Or is it Don Flamenco? Who comes around twice? I think it's Don Flamenco.
Glass Joe is the first guy.
Joe.
I mean, you could beat him on the first try. Yeah. He was nothing. I mean, that guy was like a drunk somebody, and he was.
But that's most people trading in the crypto markets, though, right?
That's what I'm saying. So everybody, just understand that we talk about it all the time. But cryptos have just been. And the other thing I say this too: if you follow them, they're supposed to be some sort of hedge against falling markets. They're not.
Right. Yeah,
they trend with the market. They correlate with the market. Just as much.
Oh, and that's why I'm saying the interesting thing with all of this, and that's what's good about a healthy correction is, I mean, even for us, it's like watching our portfolios and managing portfolios and having our philosophy, the core of our philosophy hasn't ever changed, but there's subtle adjustments that we make that improve, right? And that's what a good healthy correction does, is it makes you kind of realize, well, what's my philosophy? What am I doing? Right. And so, if you have the belief that, crypto's going to hedge for me, it's like, no. If anything right now. So, and that's the thing is this market right now is getting beat up the most in those growth speculation areas. That's where it's wreaking havoc.
Yep.
Portfolios are getting destroyed if you're at growth and speculation. Yep. And that's what crypto's 100% speculation.
These kind of corrections and recessions really make you question your belief in God. Is God real?
Is God real?
Is God real?
Market. Go read Adam Smith's The Invisible Hand, and that will actually make you think about that even more. It's a great book. Really good book.
Yeah, just remember it's 300 years old.
It is, but it's just as applicable today, just like the Bible.
It really is.
I love it.
Okay, so we got to wrap this up. So let give a little idea here, Ty. As quickly as you can. Timer's on.
I can't. Okay. About what?
Well, okay, markets do this, right?
Right.
Do you want to have your money out in the equity markets in which there's absolute risk, meaning,
Yeah.
right, risks that affects it drops 10, 20, 30%, even 100%. You lose everything if it's a stock, whatever.
Right.
What's an idea here? Bonds suck right now. Bonds are not the place to hedge right now. So what do you do?
Interest rates are this that's a good question. And what I'll do is I'll dovetail it into your overarching idea of what's your philosophy, right? Because we're taking a step back. We're asking ourselves, what is my trading strategy? What is my investment philosophy? What do I do so I don't panic? Right? That's where you say, I want to look at my entire picture of what I have. If 95% of your money's in crypto, or 50% in crypto and 50% in tech stocks,
which we've seen,
you're 100% speculation, right? That's the kind of investor you are. You're all you're hoping to do is just hit not even a home run, a grand slam. That's all you're looking to do, right? Mm-hmm. And people might do it, and you might get excited because
in the ninth.
So the idea here is, well, if you build an overall strategy that utilizes different tools, again, having crypto is not a bad thing as long as you do it the right way, right? So this is where, and I love this, when you see markets correct like this, the idea of having something that is fixed, something that is guaranteed, right? People hate the word annuity. I don't care if you hate it, right? Because at some point you need to come back around and ask yourself, is what I'm doing working? And the people that utilize 10, 15, 20%, 30% of their strategy using that tool, and even in that world of annuities and fixed income, there's a difference in how you manage it or don't manage it. And I would suggest manage it, or make sure your advisor is managing it for you, because it needs to be managed. Yeah. But the idea of, hey, look, it won't lose, right? Guess what? If 25, 30% of your portfolio hasn't lost a penny this year, because it's not going to, and it can still even be getting you 4, 5, 6, 7% this year, let's think about that. Hold on, I'm going to do some math on air, okay?
Whoa, man, this is exciting.
Divided by 12 is a little over 0.5%. Okay. So basically, when the market's down, what did we say S&P was down year to date? Year to date, S&P is down.
I'm gonna guess 14.5.
Okay, you guess. No.
Oh,
good guess. So as of close of date yesterday, it was down 11.5%. Okay. So would you rather be down 11.5% or up 1.18% on the year? Right?
I'm going to say, it's just my opinion.
Okay.
I'd rather be up 1.8.
Right.
I'm just saying.
Now, the counter argument to that is, well, wait, Ty, last year when the markets did 26% and you only did 7 or 8%, I would rather have, it's like, okay, this is the point. Have a good philosophy that utilizes these different tools.
Yeah.
Right. And that's where we are having more and more clients come around. Hey, what was that annuity thing you talked about? How's that? How can I get that? Yeah, exactly. That's what we've been preaching. Use these tools, right?
Yeah.
Is one better than the other? No, but they work different than each other. That's the whole point.
Yep.
Right? When you've got the right philosophy and you use the right tools, that's where you're just like, yeah, it sucks that part of my portfolio is down, but guess what? I got this other piece over here that's working well. Right? That is what, in my opinion, is true diversification when you have these different strategies.
Yep. And when you go back and you look at just run numbers from historical averages, just going back and doing it, and just input one that says, okay, I'm putting an annuity in that averages, let's even just say 4%.
Right.
Right. But it's guaranteed to not go below 0.
Right.
And then you add that into a portfolio that is then just out on the market.
Right.
It almost inevitably performs higher and better than if you took that annuity out and just rode the market.
And this is the thing that's interesting about this is, and again, we don't want to ever get tied into returns, right? And we're not here to preach returns. Past performance does not indicate future results. All that disclosure. The idea here is understanding how to make a better system for yourself, right?
Yeah, what's going to give you the best chance here?
I literally, for a client 2 days ago, was looking at their portfolio, we were looking at not with us. It's a potential client, and I was looking at something that we were looking to propose. And the idea is just by adding that annuity tool, 20%, what it did to their overall risk of their portfolio was invaluable, right? And that's the whole point here. Is it's not the right fit for everybody. Some people don't want it, and I get it, right? And other people like to be more real estate heavy or crypto heavy or whatever. It's like you do you at the end of the day. The point is just we always want to be critically thinking and reevaluating. And it's like, man, if I can add 20% of my dollars to something that proportionately reduces my risk, but doesn't really detract as much proportionally from the overall return, right? That's just me. I've done this so long that I want to have the most efficient return for the amount of risk I'm taking. That's what I want. I don't give a crap if I hit a home run or a grand slam. I just want to hit doubles and singles.
I'm saying
maybe the occasional triple. That's what I want to do.
Good batting average, right?
Right.
Sprayed around the field, right?
Right.
Just take you go with the pitch.
Exactly.
You go
That's a great point. Go with the pitch.
Yep.
Well, and
Punch and Judy, Brad. Brad, if you're listening, Punch and Judy. You know what I'm saying.
Punch and Judy. I loved your article in our newsletter a month or two ago, and you talked about saving, right?
Oh yeah.
Right. How powerful is that if you're a saver, right? And if you're saving and you've got that attitude, that's a philosophy where you're not a spender, you're a saver. How much difference does that make? So then when we have these corrections, you can take a step back. It's like, yeah, does that suck? Glass Joe got one hit on, but you know what? I'm going to win the fight. It's fine. It's all good.
Joe, I love it. I love the name
you
Glass
never
Joe.
probably got hit by Glass Joe. Occasionally I get hit by Glass Joe. So
yeah, he kind of sucks.
He does kind of suck.
But so
Anyways,
I
digress.
Good point.
Philosophy.
And I think that it is be open to ideas that can help. Doesn't mean you're going to do them. It doesn't mean that you're going to, push every cent into it. But be open to the ideas, because again, like you say, this idea of efficiency, right? Because people get so hung up on rate of return,
right,
that they're willing to take on whatever risk to get that, and it's like, no, do not, right? Do not.
I agree.
Shoot for efficiency, and you'll be happier.
I know.
You really will. You really will.
That's the funny thing about this, is talking to clients. There's a very big distinction between people, and to be frank, I see more success overall with the people that have a good philosophy and a plan. Yeah. Right. Than those that kind of are trying to get that home run and so that's the idea is when you take time and reflect and build out these ideas and kind of adjust your outlook, you're going to find more success.
You just are.
Plain and simple.
Yep. So and so go back to the last thing. It's the last thing, Ty, you can't talk after this. If you are tying your financial health all the way around to rate of return, you can expect worse results. There's got to be a multi-pronged strategy to
I agree 1,000%.
Reducing risk, saving more money, right? Those things build. So this plan you're talking about is very, very important. Take a step back and make rate of return a less important part of what you're looking to do.
Absolutely.
Don't make it nothing, but don't make it everything. If everything counts on that, you are going to be disappointed.
You're going to be miserable.
You will be miserable. Correct.
Yep. Let me ask you this. Could you cross the ocean in a speedboat?
Well, if you have enough gas.
And most likely you may not be able to carry enough gas because it's
true. But where we go? Are you saying like a Magellan trip, like around the world? Or are you talking like
a
to
big
Hawaii
trip? Like there's
from LA to Hawaii.
Idea is like we'll say from coast North America to Asia. Okay. Like a big boat trip. right? It's the idea.
My opinion, I'm going to say it with zero. I'm going to butcher this. I'm going to say no. You can't.
I would think not either. Especially one of those like super fast cigarette boats, right? Like you just that's not what it's built
for. The swells may just overtake you too.
Swell, so exactly. But if you've got the right vessel and you get across the ocean and you enjoy the voyage, sometimes it's crazy and calm,
and you may fall off the edge of the earth too, which is
that is true. Flat Earth. Who's the basketball player that's the flat earther?
Well, Kyrie Irving.
Maybe
hinted to that. I don't know.
Yeah. So to that point, chasing rate of return is like trying to cross the ocean in a speedboat. It's just not going to work. Okay, I'm done. Sorry.
I have another analogy.
Oh, okay. Let's hear it. I want to hear it.
But I'm not going to say it.
Oh, come on.
Off air, I'll tell you what it is. All right, fine. It's not appropriate.
Okay.
It's a good one. It's just not appropriate.
It's just not appropriate. Okay, I like that. I like it. Okay.
It has to do with marriage. I'll just throw that out.
Okay, I like it. All right. All right,
we're done.
We got it.
it. I hope everybody made it this long.
Yeah. But anyway. I'm glad you're back in the saddle. It's fun to have you on with me. So.
Yep, I am back, and I'm glad. Well, Ty, your wisdom is much appreciated,
and you as well, my friend.
Wit and humor
you as well.
Have a great week, everybody. Ty,
thanks, bud.
I hope I can come back again.
No, we definitely want you back. So it's
perfect.
Way better with you.
I mean, my name's in the title, so it's not going to become the Ty.
Ty, the finance guy.
Oh, is this? We may need to change the name.
Ty and Rye. No, Ty and Rye flows way better. We like that.
All right. I will see you later. Bye.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.